Hi, everyone, and welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. Again, very glad that you could join us. We're going to be talking about something extremely important. I think really, some of you might have already felt some of these insurance increases. We're bringing on here with us our wonderful speaker, Lauren, who's an expert in this to really break down exactly what's going on and some of the things we can do to mitigate some of these, unfortunately, big burdens of multifamily insurance rates that are just going up. But before we do that, I want to go over just a couple of things with you. As usual, we are recording this, and so we will send you the full recording tomorrow. So keep an eye out in your email tomorrow. I will be sending that along with the slides, and we'll be giving you also Lauren's information if you want to get in contact with her to ask her any follow-up questions. The presentation it's going to be about 45 minutes or so, and then we'll have plenty of time for questions. Lauren will stick around as long as you have questions. I hope we'll we'll keep them
Absolutely.
going. So don't be shy. Put your questions in the question box, preferably not the chat, so that we can keep better track of them there. And if you do want to use the chat, you can, but that will be just more like for discussion. So with that said, I'm going to tell you a little bit about Lauren. Lauren's done several presentations for us over the years, and she is an expert in this field. She is the Senior Commercial Insurance Advisor for Insurance Hub Leavitt Agency, which is a big insurance brokerage. They have specialties in multifamily specifically, and that's why we love referring our members to them. She's been with Insurance Hub for over 10 years now, and she specializes in advising clients all around the country in regards to their multifamily and other lesser risk properties. So when she's, not helping her clients, she is definitely a dog lover and rescues animals. I love that. She's originally from Ohio, but now lives in Georgia, where she lives with her husband and all of her wonderful pets. And she is just a fantastic resource, really, for the industry. And I think one of the things that it's important to know as well is Insurance Hub isn't like one insurance agency. They really are, shopping around for you and helping you kind of decide what is a good fit. So she's not really, going to make you go one way or another, but really just has a high level sort of non-biased view of the insurance industry. And so really looking forward to this presentation this year, Lauren. You've always done a great job, but I think this one is maybe a little more important even than the ones you've done in the past. So thank you so much for coming on and talking to us about this today.
Yeah, absolutely. I'm happy to be back. Thank you for having me back. I do apologize. I'm getting over some sort of sickness, so I'm a little raspy. I apologize for that. But, anyways, yes. So we are going to go over a few things, of course, centered around insurance for multifamily owners and how to prep for what's going on currently in the industry and how to keep your premiums lower. But first, just, the boring background stuff about the agency. Again, I'm with Insurance Hub Levitt Agency. We are a Levitt Group agency. I specialize in multifamily, and we also specialize in writing rental dwellings and other lessers risks around the country, so other commercial properties as well. We are based in Metro Atlanta. The agency itself was established in 1985, and we do have over 20,000 clients nationwide. We are considered a one-stop agency as well. So we do business lines, which is the department I'm in, personal lines, benefits, bonds, financial services, and HR services as well. So the objective today is first we'll be reviewing both national and international events that are affecting the insurance industry. We're going to learn about hard market issues, which is what we are in right now. So what is a hard market? Why are we in one? And what can we do to get through it as unscathed as possible? We'll also go over some solutions that you can implement and plan for in order to guard your policies from controllable rate increases. We'll talk about some good standard practices to reduce the likelihood of preventable losses from occurring at your properties, therefore keeping your market options more favorable when shopping. Lastly, and what you are all most interested in, I assume, is we'll go over what you can do to keep your premiums down during this tumultuous time. And of course, we will also have a Q&A session at the end, and I'll also be listing my email address, like Alexandra said, so we can answer any questions that go unanswered or may be better answered by a member of our personal lines team if you don't have commercial policies or are not suited for a commercial policy. So first, what is going on? As most of you are aware, there is quite a bit of an upheaval going on in the insurance industry. And while it's certainly hitting some areas and some landlords harder than others, it's still having a direct effect on a vast majority of multifamily policies. So what is going on to cause this? As a recap, in 2023, commercial property premiums increased at an average of 20%, which is pretty darn high. The overall trend of natural disaster claims was the main culprit. And while there's no real expected relief going into 2024, it's not expected to get any worse for clients in lower risk areas. The continued increase in frequency and severity of natural disaster claims is the main culprit that's driving the premiums up. So in the first half of 2023, P&C, which is short for property and casualty, which is the term for commercial property and liability policies, the loss ratio was above 100%. So carriers paid out more in losses than they received in premiums. That is not their goal. Their goal is to make money. So they lost money in the first overall half of 2023. CAT, which is short for catastrophe losses, were about $2 billion away from matching the entirety of the CAT losses from 2022. And the CAT losses have been the highest that we've seen in 2 decades, and we'll go over that in a little bit more detail in a few slides. But the annual 2023 loss trends ended up coming in slightly lower than 2022, but it still ranks above the overall projected 10-year and 30-year trends. So currently, we are in the midst of what is called a hard market, which is continuing on from last year. And hard markets cause restrictions when it comes to dealing within the confines of the insurance industry. We're going to go over that in more detail next, but as a summary, we truly are really in a perfect storm of issues because the myriad of issues have converged to cause all these increases. So it's not just one thing, it's really quite a few things that's attributing to your premium increases. Over the past few years, we have had a huge increase in frequency and in severity of natural disaster claims, which is the main culprit affecting the insurance industry at the moment. So because of the steep uptick in natural disaster claims, it's getting increasingly more difficult for carriers to be able to predict the types of payouts they're going to need to prepare for. There is also a rising cost of construction costs, specifically building materials such as wood and steel, which directly impacts the cost of rebuilding and building properties. Housing and labor cost increases have resulted in higher claims payouts for property and casualty insurance, and the rising cost of construction materials and labor has led to higher repair and replacement costs for damaged properties, which forces insurers to raise premiums to cover those increased costs. So we still have a little bit of fallout from supply chain issues, which leads us into global inflation. So events around the world do affect what's going on locally, especially when supplies obtained from overseas are used in construction. So inflation is not condensed only to the US. The inflation rates around the world are interconnected, and inflation rates over the past few years, of course, have been historically high in most developed countries, not just the US. So the surge in inflation in years prior has contributed to a heightened commercial property premium and increased claims expenses as well. So also social inflation. So when it comes to lawsuits, We love to sue people in this country. The US faces its own host of problems because of how litigious our country is. Overall, court cases typically result in high payouts that favor plaintiffs, and there is legal system abuse, higher court costs and attorney costs, and increased attorney advertising efforts such as TV ads, radio ads. I'm sure we've all been subjected to those. So personal injury court payouts have risen over 300% since 2010. So that's certainly something that's directly affecting your liability premiums as well. The claims payouts for insurance policies also remain quite high because of the cost to settle court cases is typically less expensive than letting it go all the way through the court system. Plus, you add in fraud and abuse, such as false or exaggerated claims by policyholders, plus bid rigging by contractors and contractors who collect money without completing work. You really do have an issue when it comes to the amount of money that insurance companies are paying out that maybe they shouldn't be. And then, oh, also new carrier requirements for properties that are deemed as acceptable risks. There are strict guidelines in place for a number of carriers, especially on the standard side. So we'll go over that in more detail as well. So we're going to go over just some cause and effect. This is as interesting as I could make this slide without throwing a whole bunch of text in. But 2023 was the fifth consecutive year of overall higher premium costs, and the main culprit has been natural disasters. So 2023, we ended up with about $250 billion in global losses. The first half of 2023 in the US, storms caused insured losses of about 34 billion, which is the highest ever recorded in a 6-month period. But after factoring the second half of 2023 in, the overall 2023 loss trends ended up coming in slightly lower than 2022. However, 2023 losses still rank above the 10 and 30-year trends, which I had mentioned. And some claims still do remain open, so we'll see where that final number ends up. So severe storms have accounted for about 70% in total insured losses worldwide. So by severe storms, that means thunderstorms, hail, wind, tornadoes, and hurricanes. In 2022, there was $270 billion of global losses, only 120 billion of which were covered by insurance. US alone accounted for approximately 145 billion of total losses. In 2021, there was $320 billion of global losses, 120 billion of which were insured. So I don't want to go in the weeds of how much was paid out year in and year out. The most important to remember is, of course, 2023, 2022, and 2021, because those are the recent 3 years. Now, 2017 to 2020, though, it is something to note that it was the highest 3-year total payout for insurance carriers in recorded history. Hurricane Harvey cost approximated $125 billion alone, second only to Katrina's, and Hurricane Irma adding another approximate 50 billion. So again, we're going to go over this in more detail in the next couple of slides, but it's important to know how big of an effect the increase in CAT frequency and severity has had not only on insurance premiums, but coverages as well. You've probably seen in your policies that coverages have been limited, especially in areas that are more prone to facing CAT losses. So according to all of the leading insurance publications, extreme weather events are the main culprit as to why premiums are increasing. Though it's not the sole factor, it has certainly been the costliest. So hard market. Before getting into the main cause of increased premiums for the multifamily sector, we're just going to address really quickly what a hard market is and what causes it. So we are still currently in the hardest market that there's been in over 30 years, so in a generation. It's important to know how the market cycle works. So hard markets are, it's an upswing in the market cycle that's categorized by things like, of course, higher premiums, less competition because there is fewer markets, more strict underwriting guidelines, limited market capacity, and less favorable terms. versus the other part of the cycle, which of course we all prefer, a soft market, which is categorized by having lower premiums, having more competition because there's more market availability, there's lax underwriting guidelines, and more market capacity, and also more favorable terms. So that's just a little review on what a hard market is. I did, excuse me, a deep dive into all of my top resources in order to find prevalent data that would accurately and easily show insurance claims trends. And this map by NOAA, or the National Oceanic and Atmospheric Administration, had the most comprehensive and easy to digest data. So I prefer a chart to a whole bunch of words, especially when there's lots of colors. It's easier to follow and easier to keep my attention. So I just wanted to share a few charts. This one shows the top 6 years that had the most amount of money paid out due to cat losses since 1980. So as you can see, of the top 6 payout years, 4 of those have occurred in the past 7 years. So 2017, we have 2005, which does not follow in the past 7 years. We have 2022, we have 2021, we have 2012, again, falls out of it, 2023. So the next chart shows the top 6 annual occurrences of billion-dollar events since 1980. So the previous chart showed the amount paid out. This chart focuses on the frequency of events. Unfortunately for the US, 2023 had the highest number of billion-dollar events recorded. 5 out of the 6 years on record are in the past 4 years, showing the trend of increasing frequency. So we can see 2023 had the most, followed by 2020, 2021, 2017, and then 2022 and 2011, excuse me, were tied. And again, this is the number of events, not the amount paid out. And lastly, this map shows the US data for number of events per year since 1980 that have caused over $1 billion in losses, and per year what types of claims have occurred. So keep in mind, again, this is just showing the overall frequency trends of billion-dollar events, not the payouts themselves. So as you can see by the large amount of green, severe storms are the cause of the most expensive claims, especially in recent history. So all that being said, it's a bit easier to understand why premiums have been on the increase, especially in areas that are more likely to be affected by catastrophic weather events. And especially in a hard market, you'll face an increase of carriers who have decided to pull out of any of what they deem problem areas and industries altogether. If said carriers are remaining, most have put further restrictions on what they'll cover. A few other market changes and underwriting restrictions that you should know about, and most likely are probably already aware of. If you've ever been with Nationwide, you likely already know, but they have pulled out of writing multifamily altogether, both new and renewal business. A few of the largest multifamily insurance carriers in the country, such as Travelers, Berkshire Hathaway Guard, Philadelphia, have all put age restrictions on multifamily buildings. So maximum year built restrictions have been capped between 30 to 40 years of age, unless there's been a gut rehab done to the building in the past 30 years and you can prove it. A lot of carriers are excluding wind and hail storms, especially on the East Coast, so anywhere up from Texas all the way up to Maine. Or they're implementing standalone wind and hail deductibles, and of course, still charging more for it. Even in Atlanta, where I am, considered inland, but most carriers are still separating wind and hail deductibles out for us. So it's definitely something that's affecting a lot of different areas. Underwriters are also being required to stick to the higher replacement cost calculations that actuaries are telling them to do. So insuring it for less than what their internal calculations deem is truly the replacement cost is very much an uphill battle. Also considered is wildfire scores, crime scores, specifically for major metropolitan areas, claims trends in the industry. So tenant caused claims such as trip and falls, kitchen fires, and other liability related lawsuits. Lawsuits against landlords have also been on the rise, and the cost of those lawsuits, regardless of the outcome, are pulled from liability policies. So the policy premiums have increased as well, especially in more litigious areas and states. Georgia is definitely one of them. I'm sure California, New York, you guys all know it's definitely affecting you as well. So especially when you take into account preventative exposures from landlords not requiring tenants to carry their own renter's insurance, that's been definitely a contentious point in the insurance industry because by not requiring your tenants to carry their own insurance, it means that the landlord's policy is automatically primary, whether or not it should be covered by the landlord or the renter's insurance. So by not having that in place, it falls directly on the landlord's policy, which has a direct effect on both liability and property premiums as well. So this is something I made myself, and you may have seen it in one of the Rent Magazine articles or an earlier webinar. I like to include this infographic because it is, again, the least boring way I can adequately show the most likely types of weather-related events you will face depending on where your property is located in the country. This does not mean that just because you are in one part of the country more susceptible to one type of claim, that you won't be facing something altogether different. For example, you'll see Texas is most likely to face claims due to storms and hurricanes, but it doesn't mean a blizzard won't come through and cause billions of dollars worth of damage due to frozen pipes and downed power lines, or a wildfire won't come through and wipe out a good majority of the properties in the north. So again, this is not all encompassing of what you can face. It is just the most likely types of cat losses you'll face. So now we're going to go over the anticipated trends for 2024. So what to expect? Expect rates to continue to remain high due to all of the stuff we just went over as far as the previous year claim trends. And we're still in a hard market. This is something all landlords should be prepared for. Gone are the days where you're only paying $350 a unit per door, $400 a unit, especially when you don't have Class A properties. It's just something you need to budget for. Rate increases are going to continue to offset the economic and social inflation losses, as well as make up for underinsuring a lot of properties in the past as well. So rates are impacted because of the restriction on multifamily capacity, especially as it pertains to older buildings, which carriers deem to be over 30 to 40 years old, which of course makes the majority of us old as well. It's very depressing, but that's unfortunately how they view anything older than 30 to 40 years old, particularly of frame construction, so wood builds that don't have any additional building safety features above and beyond what is required by law, such as sprinkler systems, and for sprinkler systems being throughout the entire building. The most competitive multifamily carriers are now only allowing A and B properties that have been built within the past, again, 30 to 40 years that are in good condition, in a good and safe area, and up to code. The reason behind this is because based on claims data, older frame built structures are more likely to face claims than newer ones. And the older the building, the more likely it is that main systems like electrical and roofing will break down. Wood frame, of course, is also the most prone to catching and spreading fire. Most carriers have set new parameters with regards to the type and age of buildings. So For those that have older, especially frame buildings, which is probably a majority of you, expect rates to remain high. Overall, you can expect probably between 10 to 25 to 50% increases if you have good loss history. 25 to 50 to 150% increases for a poor loss history, or if you're in an at-risk state such as Florida, Texas, California, states like that, and if you're really on the ocean on the East Coast as well. Also, expect to see carriers requiring you to carry higher deductibles than before. I don't know any carriers nowadays that are still offering $500 deductibles, $1,000 deductibles. Most are going to want you to carry deductibles starting at $2,500 at the lowest, but still using your insurance policies for catastrophic claims is really going to be in your best interest instead of filing anything that you can pay for out of pocket. So depending again on the area of the country you're in, expect to see separate wind and hail deductibles. Like I said, in Atlanta, we're still about 4 hours from the coast, but we're subjected to the same thing that those that are in Charleston, Tampa, anywhere up the coast are subjected to as well. Also prepare for reductions and restrictions in coverage types. So as we briefly touched on, in a hard market, most carriers are putting further restrictions in place for coverages as well. For example, in California, the carriers that are remaining for new business are generally not offering high liability limits in excess or umbrella form due to litigious trends, where it may have been a lot easier for you to obtain an umbrella for, let's say, 5 million. It's a lot more difficult since many carriers are restricting their limits to reduce their liability in case of a claim as well. So, what can you do to obtain competitive insurance rates? Now, this is what everybody is probably most interested in. The first part is focus on safety. Please make maintenance a priority. I cannot harp on this enough because carriers cannot harp on this enough. I've seen a lot of non-renewals come through, not even because their carriers are no longer writing this type of property, but because maintenance, the grounds themselves are not up to standard. There's trip and fall hazards. There's things that are dangerous that insurance carriers deem to be dangerous on the property. These are avoidable. So it's controllable. It should be a top priority for every landlord, especially because we love to sue people here. Keeping the property well kept and clean, it's only going to benefit you and your tenants. Please make repairs before they get worse and therefore more expensive. Always getting ahead of the problem. So as mentioned earlier, slip and falls are the major cause of liability claims for landlords. Most of these are due to issues with things like grounds or stairs surrounding walkways, tree limbs, tree roots, things like that. So please make sure your property or your property management company or yourself are doing regular checks of the grounds to make sure that everything is clear. Please also look at installing security cameras so that if something were to happen on your property, it is easier to find out who or what caused the issue. It also helps to prevent that issue from being an issue again in the future, and also prevents fraudulent claims. So you can see on camera that if someone comes to you and said, I tripped because the concrete was broken, and there's no proof of that, you have more of a leg to stand on if it has to go to trial. It's also great to turn that kind of thing into your insurance agent as well, or your insurance carrier, to make sure that everybody is being kept up to speed on things like what you deem to be false claims. So also require your tenants to carry renter's insurance. We're going to go over that in more detail as well, but it's definitely something to harp on. So next, upgrading building systems. This is by far the most expensive route to go, but if you're especially those that have, a lot of units, looking at this as an investment, not only as an insurance discount, because you do get discounts, but also just from protecting your property in general. You're protecting your assets. So look into this and see if it's something that's feasible. Sprinkler system retrofitting. Older buildings typically are not going to have sprinkler systems, but yes, it's very costly, but look into retrofitting it and see if that's a feasible option, because carriers typically give about a 10% discount when there are working sprinkler systems, and it has to be throughout the whole building as well. Also, central station fire alarms. Central station fire alarms are more than just CO2 and smoke detectors. It's a fire alarm that, if tripped, automatically connects to either your local system or the local fire department, so no one has to make a call. It's more life preventative than anything, because no one has to be on site to call it in. It's just an automatic notification system. So they're typically discounts for central station fire alarms are between 5 and 10% as well. Also, replacing roofing, wiring, plumbing as soon as it is needed. If you have, especially electrical, that is not completely up to date. If you have knob and tube wiring, obviously, if you have aluminum wiring, if you have electrical panels that are Zinsco or Federal Pacific, please get those updated. No standard carrier will take you anymore. You will automatically be paying more for insurance because you're having to go to E&S or excess and surplus lines, and your property is a much higher risk of catching on fire, and no one wants that. So the best thing you can do if you have out-of-date electrical is getting that replaced by a licensed electrician. So yeah, I mean, I'm not under any illusions that all of these are likely to come at too high of a price point to be immediately effective, but hopefully it will provide you some good goals to reach for, and maybe you'll end up prioritizing building safety features next time you look for properties, or you have a big influx of cash, you wonder what to do with it. Of course, wouldn't that be nice? So you don't have to pay for any of the extra features, especially when going for new investments. Looking for those building safety features will definitely benefit you. Also, make sure that you know your claims history. Nowadays, and we're going to talk about this more in a minute, we have to see the actual loss history document provided by the carrier. Verbal confirmation is no longer acceptable. So go ahead and request loss history if you're going to be reaching out to other agencies for quotes, because only your current agency on record and you as the policyholder can obtain that. Now, if you have personal lines policies, it's different. It's called a clue report, and clue reports can be pulled by anyone. On commercial lines, that is not the case. So if we are not your agent on record, we cannot pull your loss history on your behalf. We can help you do it. There are ways that if you are unable to get a hold of your agency or agent to get that done, there are ways to circumvent that. Keep in mind, though, eventually agencies, they find out because carriers notify that the agencies, the carriers have requested loss runs. So it's not something that's really avoidable. Lastly, work with an agency that specifically focuses on multifamily and rental properties. Of course, like Insurance Hub Levitt, it will only end up benefiting you in the long run. Specialized agencies have access to carriers that your local agent might not have access to. And those who specialize in your industry we are very much up to date with what's happening in the market, and we can advise you and your specific situation as to what to expect and what you can do to make you more favorable in the light of insurance carriers. We can also be a partner to you to make sure that you are keeping up with what's going on in the industry. And while it's absolutely great to work with local agents, sometimes, especially when it comes to multifamily in the market that we're in currently, just make sure that your local agent has access to markets that will look at your portfolio, not just one or two, especially if you're looking at a captive agency like State Farm, because State Farm only works with State Farm. There's no way for independent agents to get access to them. So if you are with a captive agent like State Farm or Farmers, reach out to an outside independent agent and at least just see what's out there. It's certainly not going to hurt. So what to do? As a recap, prepare and budget for inevitable increases. Also prepare your properties for the most likely weather scenarios in the area. Go ahead and request loss runs and have your agent or an agency that you reach out to provide updated replacement cost valuations so you know what to expect upon renewals. Please adhere to any outlying loss control recommendations. And I say recommendations because, as we all likely know, recommendations are really just a way of saying requirements. They're not recommendations. You have to do them, or the carrier will likely drop you. So if they are brought to your attention, please adhere to them. Again, insurance carriers do not want to pay for claims and you don't want to file them. So it tends to be in your best interest to adhere to their requirements. Also, strategize with your broker and create a custom approach based on your situation. The last one is the most important because your agency should be empowering you with specific risk managed strategies for your individual portfolio. Okay. As I mentioned earlier, in a hard market, it takes longer to obtain quotes from carriers because fewer carriers are offering terms. So those remaining in the multifamily space are inundated with submissions. On average right now, underwriters are getting between 100 to 150 submissions a day. Therefore, it takes longer for quotes to come back, if they come back at all. Since capacity is limited and carriers do not have the time to look at every submission they get, they prioritize based on the information that we as the agents are able to provide them up front. So your goal is to be this guy right here, get to the top of the pile of submissions that underwriters are getting. While there are some expectations, carriers will not release quotes until they have a full scope of the risk. So what can you do to help make sure your submission won't fall to the wayside and make a priority for underwriters to look at and hopefully quote? First, make sure you approach the market in plenty of time, but not too early, as underwriters aren't going to look at quoting your risk likely until between 60 to 90 days from the effective date of coverage, unless we're looking at a midterm change. Carriers don't love it, but it can be done, depends on the reason. Most of the information needed to quote can also be found in your current declarations pages or your policy. If you can provide that, agents will bug you less. There are other ways to obtain the information if you truly are not comfortable releasing that, but this is by far the path of least resistance, as the policy has pretty much all of the information needed for us as agents to get your submission out to market. Especially in a hard market, underwriters do not want to waste their time quoting against a carrier they have no hope of competing with. Underwriters are pretty familiar with their rates, so if we approach a market and one of the main questions they ask after getting all this in is, what's your target premium? We have to give them a number. If we cannot give them a target premium, they put you at the bottom of the pile. It's not, is it fair? I don't know, probably not, but it is the way it is at the moment because of everything that carriers are having to deal with on the underwriting side. So giving them a target premium to meet is key nowadays to getting them to respond quickly so they don't waste our time either. No one wants to waste anybody's time. So this is definitely the path of least resistance. Something to note, because I get asked this not often. Most of my clients understand and they do send declarations pages, and people that want to shop understand that it's definitely the best way to do it. But some people ask me things like, why can't you just give me your best price? There's a few reasons. One is the price is not up to me, unfortunately. It's not up to any of your agents. We do not hold that kind of power. Our job is to sell you to the carriers and also to sell the carriers to you. So it is symbiotic in that way. We can have uh, some pricing relief, but we are certainly not the ones to set the price. If I just ask them, the carriers in this kind of market, to just give me your best price, they're going to go tell me to stick it where the sun don't shine because they don't have the time to go through the days and days it takes of underwriting to just wind up that they were never going to be competitive in the first place. Please don't shoot the messenger. This is just the feedback that I get from all the carriers when I have gone to underwriters to say, I can't tell you what a target premium is because the potential client won't tell me. That doesn't help anybody, unfortunately. So by giving the declarations pages, what I personally do is I severely undercut it. I understand, especially if you're just shopping for price, we will not win your business if we just cut it down by $1,000 or $2,000. It's not worth you moving. I get that. So that's the way, unfortunately, the agents have to play is severely undercutting what your current premium is, not even necessarily your renewal premium. But anyways, I digress. It's just something that comes up a fair amount and can cause contention during the shopping process. So I wanted to explain to everyone why we ask for that information. Also needed is estimated rental income, which is of course simple enough. A rent roll will also suffice. We don't need names. We just need rental income. It's also helpful if you have a larger portfolio. Rent rolls provide a breakdown of the units per building, which is not always information that we can find, but is needed in a submission. So rent rolls are great because it helps us divvy up the units per building, square foot per building, and of course the rental income. So lastly, once we're about 60 days from the renewal date or the cancellation date, go ahead and request those 5 years of currently valued loss runs. As I stated before, I get told all the time, I have no claims. That is great. Then the loss runs will come back clean. Carriers have to have the written proof of claim history, especially now, or some sort of official statement saying that there haven't been any claims. Submissions without an official loss history are, again, automatically, you're put at the bottom of the pile. Those with the loss runs are prioritized above all other submissions. So no, it's no longer acceptable to just tell me that, oh, there haven't been any losses. Not that they are known to be the most trustworthy group of people, underwriters, but they do need proof. If you don't have any losses, the loss runs will come back and state there have been no losses. That is the official document that is needed. Now, if you have had claims, of course, we'll want to know what's been done to mitigate the issue to prevent such claims from happening again. Agencies that specialize in multifamily will also be able to help come up with a plan for you if assistance is needed. So if you're not sure what to do, what to put in place, then that's something that specialists can help you with to make you more appeasing to underwriters. For new purchases, it's a little different. The best thing an agency can have is a copy of the OM. a copy of the lender requirement if you have any, or especially if you say, I'm with Fannie or if I'm with Freddie, I pull those all the time. I know the requirements for that. Uh, Also, any copy of inspections that you might have on file, especially if you're in Florida, if you have a 4-point inspection, please include those. If you haven't had one in a while, please get one done. It will again benefit you to have that on file. Also, the seller loss runs. These should be requested through the seller's agents, and we'll talk about that in a second. And also a quick note on OMs, on offering memorandums. Please don't pay attention to the insurance estimates. I have found that they are very rarely within the realm of being accurate. So basing your underwriting on what the OM's insurance estimations are is no good. Please talk to someone about it beforehand. Okay, a couple pro tips to consider. Again, before closing on a property, please request 5 years loss history from the current owner. If it's clean, there will be better rates for you. And if it's not clean, then you can use it as a bargaining tool when purchasing the property. It will also help you get ahead of known potential issues that the building or the management company has faced in the past. And for older buildings, it will also be required that you have to find out what year roofing, wiring, and plumbing were last replaced. If you are on the East Coast side, also HVAC systems, if you've had those replaced as well. Approximate year is okay, but not knowing what you have, what you'll have to face in terms of property investments, such new roofing is not cheap, and bringing aluminum wiring or knob and tube wiring up to code, it can be even more expensive. It will absolutely come back to haunt you. An unexpected and large cost especially can sink a lot of people. So please make sure that you are protecting your new asset by finding out the full picture of what you're buying before you buy it. It needs to be something that you require of the sellers before you purchase a new property, because not doing so can cost you big. Also, reminder, insurance will never cover general wear and tear. It is the responsibility of the property owner, property management company, to make sure the building is in good working condition. So if there's a plumbing leak or a roof leak due to wear and tear, you are out of pocket that cost. So again, inspection is important, loss history is important, so you can get ahead of any potential issues. Also, the presence of any of the following will make you ineligible automatically for standard, therefore competitive insurance coverage. Aluminum wiring, that also will include knob and tube wiring as well. Polybutylene or PB piping or blue piping. Wood burning fireplaces, also a big no-no at the moment. Higher vacancy rates, so anything above 25%. Typically, carriers really want to dive into why. Higher crime score areas, high wildfire scores, high claims history over the past 3 to 5 years. Frame buildings over 4 stories without sprinkler systems and central station fire alarms. I'm going to edit that to say just frame buildings in general without sprinkler systems, central station fire alarms, for a lot of the country is now really having to go non-standard. It depends, but you can put a little asterisk by there. And lastly, coastal properties. Not so much on the West Coast, but East Coast properties. All right, something I always harp on, and I will keep harping on. Should you require your tenants to carry renter's insurance? Yes, big resounding yes. As the landlord, you are absolutely allowed to require your tenants to carry renter's insurance, either in terms of a new lease or a renewal, for the most part. I understand, especially like California laws, there are some very specific ways that make it really, really hard to, and there are solutions for that, but there are too many benefits to requiring your tenants to carry renter's insurance to outweigh not requiring it, if at all possible. One, of course, on the tenant's plus side, it protects their personal property. So of course, that's a benefit to the tenant in case there is damage to the tenant, or someone breaks in and steals steals their items. It also, though, protects you as the owner against negligent destruction of property. So if a tenant causes damage, you as the landlord have a course of action to take that does not involve uh, turning a claim into your policy. So we want to protect that. We want to use that for something for causes that really we can't do anything about, but most tenant caused claims are preventable. So it's definitely something you want to take stock of. It can also provide dog bite liability if you allow animals, then that's of course something you want to make sure is covered. It is a way to weed out undesirable tenants. Uh, I am of the belief that, and I know a lot of people have Section 8 and HUD housing, and it's of course so important for everybody to have access to housing, but having a $5 to $10 renter's insurance per month should be required on the landlord side, because it really does not cost that much, especially if you have someone, your tenants have cars, you're not in a major metro city. They likely have a vehicle, so that means they already have to deal with insurance. Adding it on to their current auto insurance using that carrier should be very easy to do. It also helps with relocation expenses and the result of damage that makes one or more units untenable for an extended amount of time. It also mainly lowers the chance of your insurance increasing due to a claim caused by a tenant because it reduces a risk of a lawsuit against you. We highly recommend that you require your tenant to name the entity that owns the property as an additional insured, so you can not only be notified if the tenant's policy cancels, but also be protected if there is a lawsuit. Regardless, if you are named in a lawsuit because of a tenant caused issue, then you have a barrier of coverage between the claim expenses and your policy. If every landlord required their renters to carry renters insurance and upheld that requirement, there would not nearly be as many claims flooding the industry. So while it's not the main culprit for the rise in premiums, master policies paying out for claims that should have been covered by a renter's policy has certainly been a factor in premium increases, especially on the individual scale. I have seen a lot of clients and potential clients that have had a huge claim that unfortunately probably would have had they required renter's insurance, the renter's insurance would have taken primary instead of the landlord's. So I know it can be easier said than done, but if it's hard, or I equate this process of having tenants to um, uh, require them to carry their own renter's insurance to chasing around toddlers. I know it's not fun. I know it's a nonstop issue. There are ways that you as a landlord can hold what's called a master renter's policy on their behalf. So it's something that it's a pass-through cost, which is great. You're not out of pocket anything. Levitt, the agency, we have a program that it's available nationwide. You can have, again, it's passed through. It ranges between $7 and $12 a month. You can also, as the landlord, add on your own fees to it. So that's certainly beneficial. And we don't need tenants' names. We just need to know the number of units. And if there were to be a claim, that's when we collect the tenant's information. So it's a way that you can sleep well at night knowing renters, every renter, every tenant has renter's insurance. You don't have to worry if there's a lapse because you are the one in control of it. So that's something that's definitely gaining in popularity, and I did want to make a note of that as well. Lastly, how to reach me. This is my direct number in my email address, and my not so trusty assistant, Gus, one of my dogs, he is currently sleeping behind me. So he's not going to get much done, but he is cute to look at. So I like to include a photo of him as well. But that's everything, guys.
I always love seeing Gus's photo there. He's so cute.
Thanks. I know he's
Ah,
ridiculously cute. And thank you
adorable.
guys also for sticking with me for
Seriously.
losing my voice. I apologize
Lauren, you
for
are a
that.
trooper. You did so good. I could hear your voice starting to give out, but you kept
Sorry.
going.
Sorry about that.
It's okay. Thank you for still making it. I put up a poll question if you want your policy reviewed. Lauren and some of the individuals on our team who are also really great can help you do that. It is free to do it. No harm in, I guess, finding out if you
Yeah.
have a good policy, what's out there. I always think it's worth the time. That's really all you're putting in, right? Just the time to talk to them and to maybe get a few documents together so they can give you a really good analysis. So I'm
Yeah.
going to leave that up there for a little bit. I know some of you put in the questions that you wanted Lauren to reach out to you specifically. So,
Absolutely.
we'll be reaching out. Now we have a ton of questions in the Q&A, and I know there was a lot
Perfect.
of conversation in the chat as well. Because we have so many questions, I will only be taking questions from the Q&A box. So please put any questions, if you put them in the chat, put them in the Q&A box right now. I will go in the order that they were received, and we will hopefully get to as many as possible here.
Sure.
Lauren, do you have a hard stop at any point?
I do not. Just
Okay.
my voice if it gives out, but I have water.
Yes,
I
your
drank my
voice.
tea.
I
So,
know. Well,
no,
thank you
but
for
I'm good.
sacrificing
I
your
can keep
voice
going.
today.
No, it's totally fine.
Okay.
It's going to happen
Well,
regardless.
Faye is asking, if I have an LLC entity as an owner, is it better to have a commercial policy versus a homeowner's policy for a multifamily home with renters?
Great question. And yes, if you have an LLC set up, that makes you a business. And therefore, a business policy is going to be more appropriate for what you do. Something, though, that can make it confusing. Renter properties, especially when you come to like, especially in the 1 to 4 unit market. So if you have a single family dwellings up to a fourplex, you are eligible for either single family or commercial. It is pretty much the only uh, industry that you could go either way. Usually there's a hard, it's you have to go to commercial, or you have to go to personal. This is a murky area. It is cheaper to stay in personal lines, without a doubt, because coverages are lower, and that's just how personal lines are made. The exposure on the personal line side really um, isn't as great on as it is on the commercial side. So you can still get away with it, but especially if you are looking to grow your rental properties or have a myriad of rental properties and they're all, but at the smaller unit count, start looking at commercial options. It's not, if your main goal is to save money, it's not going to be for you. But if your main goal is to reduce the number of headaches you have and also be as protected as possible, then it's definitely something to consider.
Yes, and we often have our asset protection attorneys do webinars, and they always recommend the
There you go.
commercial insurance for that reason. They
Yeah.
see a lot of people come to them
Yeah.
after they realize that their insurance doesn't cover them to see if there's anything else they can do. But
Yeah.
they usually always say that insurance is that's the first line of defense, really.
Absolutely. And we
Mhm.
do on commercial, there are most of the markets for, single family rentals and up to 4 units um, are mostly going to be found on the personal line side. Commercial, we certainly have them. It just, it really just depends. So I know
Hmm.
that's not a straightforward answer, but commercial is probably the best way to go. You have
Yeah,
LLC set up.
definitely a good to weigh that.
Yeah.
Faye asking if there's less competition, I may need to have the policy underwritten by a non-admitted carrier.
Mhm.
Is this a huge risk that is worth it?
That's a good question. And a lot of the times, so non-admitted is the same as excess and surplus or E&S for short. So you'll hear those terms used interchangeably. The 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 main answer is no. It's really most of the time is not a big deal because insurance carriers, even if they're not admitted, they still have to be reinsured by top rated carriers like London, like Lloyd's of London and Zurich. Um, so so that's something that even though you'll probably have to pay a bit more money, top carriers like Lloyd's of London and Zurich and Chubb, they are non-admitted in most states, and but they're still A-rated carriers. So it's not something that you should be too fearful of. The AM Best rating is really what to pay most attention to.
Okay. Well, great. Alexander asking if a tenant has renter's insurance, should the owner require that the owner's name also be on the policy?
As an additional insured, yeah,
Good. Okay.
absolutely. Yep.
David asking, do you know or have heard of any liability claims issues not being paid out and why?
Oh, sure.
Mm.
I mean, liability lawsuits, just like lawsuits in general, it's not 100% hit rate. It's going to depend, but a lot of the times, and I guess I don't know if he means like court payout costs or like insurance payout. Generally speaking, um, what I've seen is that some amount on the insurance side is paid out because you still have to defend to defend yourself and liability. The attorneys on the carrier side still have to look into it, and so they still for have to be paid to do that, and that costs money, and that money comes from what you pay towards your premiums. So things like trip and falls, unless you can prove that it is a fraudulent claim, and like I said, things like security cameras will really be in your benefit in that regard. It's a hard thing to prove, especially depending on the state that you're in, whether it depends on whether the courts tend to favor the plaintiff or not. So
That's a
doing
good
what you
point.
can as a landlord, having security cameras, especially on the external side, will only help.
Yeah, good point. And also asking if we were to update the electrical panel for each unit, would
Mhm.
this be considered favorable for insurance?
Yes. Well, it depends on what you started with, but if regardless, standard carriers are only going to um, standard carriers are only going to take you and keep you if your electrical panels are up to code. So if you have Federal Pacific or Zinsco, those are the two main panels that are absolute no's. Please go ahead and get those replaced. And bringing electrical up to code in general is definitely what carriers are going to want to see.
Hmm. Nataya asking, would a higher deductible from $5,000 be your or more be your advice to lower the insurance premium? Please comment.
So I say this to pretty much everyone. There is no wrong answer when it comes to insurance deductibles. It depends on what you're most comfortable with. If you can swing it, go with a higher deductible because it will affect the premium. Just like any other insurance premiums, on personal side, with your home or your vehicles, it doesn't make the difference that you might want it to make, jumping from 5,000 to 10,000, depending on where you started with, depending on the units, could certainly have a bigger impact. When you get from when you start at 10 and go up from there, that's really when you see the bigger impacts come, like the over $5,000 of savings when you come to larger portfolios. So yeah, if you can swing it, by all means, carry a larger deductible.
Okay.
It'll certainly help.
Good. Well, Joel asking, will insurance companies send a safety expert to come out to your property and recommend improvements to reduce potential safety issues?
So generally speaking, they're called loss control.
Mm.
Loss control reps come out, or some carriers do it electronically now, especially in the time of COVID when carriers really no one wanted to or could go out in person. They will ask you to send photos. and they'll also look at the data they have on file. They pull photos from the internet. So like Google Earth is a big one. Um, if if they don't, so if they, let's say if they do, and you're like, this is wrong, then you just need to show updated photos that it's not correct. But generally speaking, especially on larger properties, if you just have a single family rental, no one's going to go out. But if you have, over 50 units, it's highly likely someone is going to go out, and it's highly likely that it will benefit you as well.
Good.
Yeah.
Um, M. Clark asking how to obtain loss information on an investment property that may be under consideration.
So under consideration, meaning you don't own it yet. So that
Right.
means ask the seller for the loss runs. You just ask the seller, the seller's agent, whoever the contact is, for, I would say, 5 years currently valued loss runs. That's the phrase to use, is currently valued. So that means that it has to be pulled within the last 60 days. You can't, if you send over loss history because there's a date, it says when it was requested. If it's requested over 60 days ago, carriers are going to be like, well, this isn't up to date. We
Mm,
want loss history as close to the effective date as possible. So make sure you use currently valued loss runs. So they're not sending you, like, oh, I have loss runs that I asked
good
back in
tip. Good
2022. It's like, well,
tip.
great, that's fine. And that could help move you up the pile a little bit, but you're going to need currently valued loss runs.
Good point. Terry and Deborah, piggybacking off each other's questions here. We require
Sure.
renter's insurance and are named as interested party or additionally insured. We
Perfect.
require 100,000 minimum. Is that enough? Deborah says she requires 500,000 liability, 10K personal property, 3 times the monthly rent, and temporary relocation coverage. Any other
Great.
requirements to consider there?
I think yeah, y'all are on top of it. I think it's good
Deborah
that you guys are
definitely is.
doing it. Yeah, Deb got it. Um, Everybody take a note from Deb. It's definitely something, the jump between premiums from 100,000 to 300,000 to 500,000 is fairly nominal.
Mm,
So like I said, with Levitt's Master Renters Insurance Program, we have it ranges between $7 and $12 a month, and that really depends on the liability limit that you want. So it does range from 100 to 500,000. So it's not a huge difference, generally speaking. I'm sure there are some companies that it ranges more, but that's, if you can make it higher, great, because it's just a couple dollars more a month for the most part.
yeah. And the landlord can pay that too, right? It doesn't have to be
Yeah.
paid by the renter necessarily. Okay.
No, it does not. If you're going
Okay.
to do it, if you're going to take that on yourself, though, instead of like reimbursing or anything, do have your own master renters policy for
Mm,
on behalf of the tenants.
that makes
So,
sense.
and and something to the master renters policy, it's not an all or nothing. If you have tenants that, your perfect children that never do anything wrong, that carry their renters insurance, and you never have problems with them, if they want to keep their own, great, and you just want to sign everybody else up, um, fine, you can do it that way. It does not have to be all or none.
Okay.
Yeah.
Um, let's see. M. Clark, can high insurance zones or fire zones be identified or determined in advance to get an idea of potentially high rates?
Uh, Through us, yes. So that's just something typically, because I know I talk about underwriters a lot. Our relationship with the underwriters is so important, because they can say no, they can just not work with us. But being on their good side is great, because I can ask a lot of them and say, hey, can you please tell me what zone this is in? Because we agents don't have access to that. We can pull some preliminary data, but the underwriters are going to be the ones to say yes or no. And if one carrier comes back with a high wildfire score, they're all going to come back that way.
Mm,
So yes, you just
makes
have to let
sense.
us know the address, and then we can help run that for you.
That's super helpful.
Yeah.
Tina asking, do insurance carriers more likely need 5 or 3 year loss runs? And also, how do third parties fault incidents, car running into our property and causing damage?
Great questions for both. I would go ahead and say 5. I mean, at this point, what I like to do is if the so let's say you request 5 years loss runs and you had a claim 4 years ago, I'll only turn in 3 years because it makes you look better. If they ask, if they're like, no, we have to have 5, then I'll begrudgingly turn it in, of course. But if you have 5 years of no losses, you look even better. So that 5 years of no losses looks better than 3 years of no losses, if that makes sense.
Mm,
Some carriers are still only requiring 3, but 5 only again puts you on the top of the pile because you're showing like, hey, I'm serious about this. I'm on top of it. I'm my risks, I take care of my stuff. So go ahead and request 5. And what was the second question? I'm sorry.
if there's like a car running into your
Oh, yes.
property or
Okay.
something like that.
Well, unfortunately, it's still, I mean, it still counts against you, but it's not your fault. So it's not something that's like, oh, well, we had an electrical fire and it caused $500,000 of damage because electrical wasn't up to code. That looks real bad. If you have a random event like a car running into your building, while it's still something that hopefully the person had insurance and their insurance is primary. Hopefully that's the case, but you'll still probably have to pay some property damage amounts. But it's certainly more it's more explainable because it's a random thing that, I mean, unless you've had 2 of that, it's like, well, then that's a strange pattern. Underwriters look for patterns like that. But if it's a one-off, it's usually pretty easy to explain away.
Okay.
Just depends on the scenario. Yeah.
Sure. Is it possible to get insurance on a building with 4 apartments, but liability only on a second unused building on the property?
No. Nope.
Okay.
And even so, I wouldn't do that, even if
Mm,
you asked me to, and we could, because liability, I would do it the opposite way. If you didn't want property insurance on one building and another, great, that's fine. For whatever reason, I mean, it's not fine, but it's certainly more feasible than liability because liability is the premises itself. So you can't pick and choose who you want liability for. And liability itself is, in the grand scheme of things, a nominal price versus property, that it doesn't make sense to pick and choose that way. And underwriters are also going to be like, why would that be an approach to take if you're already insuring one building? It's the parcel that
mm,
carries the liability. That's what it is. So no, that's not something that you'd want done either, even if it
okay.
could be. Yeah.
David asking, number 1, please explain loss of use from damages where the tenant can't live in the unit. How does insurance handle that? I guess I'll go with the
Okay.
first
Yeah.
one
Start with
first.
that because my memory. Um, Loss of use. So if there's a covered cause of loss, so a fire, it can't just be because they can't pay rent. So let's say there's a fire and it affects 2 units, and they have to leave because it's not tenable anymore because you have to fix the units. Then business income or loss of rents is the coverage that is triggered. That covers what you lost or what you would potentially lose. Um, because you can't collect that from the tenants anymore. They're not living there. And then also, if you include, it's called extra expense, then that's something that you can pay for the tenants to live somewhere else while the damage is being fixed.
Okay.
So that's what it's from.
The
Yeah.
second part of that question is how
Mhm.
does renter's insurance come into play in that scenario?
So that's a good question. And sometimes it overlaps because renter's insurance should have their own, loss of rents, business income coverage. It's you generally automatically included. So it's but you can have it for different reasons. Business income, loss of rents on your master policy is more all encompassing of you being able to regenerate that loss. On the renter's side, they're the ones that they can pay to live somewhere else. So that's what the renter's insurance typically covers. But I'm not in personal lines, so I don't know if they have a some sort of rider or something that says they can also pay you back, but generally speaking, it's just for them to pay to live elsewhere while damages are being fixed.
Mm. Okay, well, I think that answers Nataya's question as well.
Cool.
So
Great.
awesome. I'm going to go ahead and mark that one. Ian had a couple questions. It says, we have had our three 1966 properties with NW. That's
Nationwide, I
nationwide.
assume.
I
Yeah.
was like, wait, which one is that one?
Yeah.
Since about 2006, with average 5-year loss history, they renewed us in June of 2023.
Good
Would
for
you put
you.
money on guaranteed non-renewal for June 2024?
I would put money on that.
Mm,
Yeah, I would.
okay.
But you
Well,
know what? I when carriers make these big blanket statements like we're non-renewing and we're not doing any
hmm,
of this anymore, if something slips through the cracks, I'm not going to point it out. Ride that wave while you can, but I would bet that it's something that likely won't fall through the cracks. I hope it does for your sake, but
yeah,
it probably it probably
maybe they
won't.
didn't notice and won't notice
You should
again.
be prepared for it not to go that way.
Yeah,
Yeah,
definitely good to explore some options, perhaps.
absolutely. Yeah.
So let's see here. He was also asking if being an additional insured on a renter's policy would make him liable for policy premiums or pit us against ourselves effectively if our carrier and tenant's carrier go to battle.
No, it shouldn't. It shouldn't make you liable in that regard. You're just an additional insured. You're not an additional named insured. Those are two different things. So additional named insured would mean that you have more stake in the policy, but additional insured just means that you're notified of changes and you have coverage based on your entity has coverage based on the on that underlying policy. So it's not really something that I mean, maybe it could happen. Who knows in the judicial system what could happen and what attorney could do with that information. I don't know, but it's certainly not something that I would worry about. And what was the second part of the question? I think I answered the first part.
Yeah, it was, yeah, if our carrier and tenant's carrier go to battle, I
Oh,
guess.
It's, I
I,
mean, they're going to go to battle regardless of whether or not
yeah.
you're named on the policy. So it's called subrogation, which is in the back end, the carriers suing each other. It's just a nice way to say sue. And that happens all the time with claims. One carrier thinks one party is at fault, the other one is the other, and they have to sue each other for damages and claims costs and all of this stuff. So that's going to happen regardless if the scenario calls for it.
Hmm.
So I'm
Uh,
listening. I'm getting more water, but I'm still going
yes,
to answer.
please get water.
I'm listening. I promise. I can still answer. You just won't see me.
Okay, okay, awesome. So we have Marissa or Marisa, I'm not sure. She said, when shopping, should the target premium be the current premium given the rising premiums or some
Great
percentage
question.
more?
I love that question. Okay. It depends is the answer. What I do, again, it's very much based the uh, on the expiring term and what the situation is. So I know I'm not like, listen, if it was built in the 70s and um it's wood frame and it's in not a great area, like I'm not going to go in and ask for $400 or $500 a unit. It's not going to get done. And they're going to be like, we can't touch this, so why even bother? If we underscore too much, the underwriters are just going to say there's no way we can touch that premium, so we're not even going to look at it, which I get as well. Again, they don't want to waste their very valuable time. So a lot of the times I do look at renewal and say we're just going to use the previous year's premium as the target premium, as long as it's reasonable. If you were with Guard and paid $350 a door for this whole past 5 years, I'm gonna have to bump it up a little bit, but that's very rare. So that's a good question. That's typically how I do it. Is I look at the past term, and but if I think that it wasn't competitive, I'll cut it down even more. So if you have, I don't know, 100 units and you're already paying $100,000, I'm going to ask for less. All if the losses are clean, I'm then it doesn't make sense that you were paying that much. So it goes that way too, is making sure that that we look at both sides, that we're not asking too
Yeah.
much or too little. It has to be reasonable but competitive. So
I think that's the
hope that
value
helps.
of working with someone like you because you obviously know what
I
would
look at
make it,
numbers a lot.
yeah, like
Yeah,
you see these
yeah,
every day. Like
I
when
do.
we're looking at our own policies, we don't know what other people are paying necessarily. So we don't know sometimes if it's too high or too low. So it's good to know
Yeah.
as someone else to kind
And
of tell you.
yeah, and another thing too, and it doesn't happen often, but people are like, well, my friend is paying XYZ. I'm like, well, that's great. But we're probably not comparing apples to apples. So there's probably reasons, if it's too good to be true, it probably is. If it
Right.
sounds too good to be true, it probably is. So it's just it's something that we have to take individual property characteristics into account before making that that number like a solid number final.
Yeah, got
Yeah.
it. So there was a few questions about just property types. So I know
Sure.
this presentation was geared towards multifamily.
Yeah.
So there were some questions about how do you define multifamily? So we define it
Yeah.
as 5+ units. I don't know
Yep.
if it's different in the insurance.
It
Um,
no. I
Same.
mean, I guess technically and legally speaking, multifamily is more than 2 units, but in the insurance world, because it's multi is more than one is so yeah. But in insurance, it's the same as 5+ units
Okay.
per
And then
building.
if we have people here on the call with like a duplex or a condo, what are some of the differences, I guess, between that and, you know, the
Multifamily, yeah.
multifamily? Yeah.
So it depends. If you have a complex of, you know, 10 buildings of 4 units each, that's still multifamily. So it really depends on the makeup of your portfolio. If it's really just you have one rental condo, that would probably be best fit in personal lines, price wise and coverage wise. I don't, I have maybe a couple carriers, but it's expensive when you put just that on a commercial lines policy. So if you have that along with a whole bunch of other stuff, that's different. So when you start looking at like 10+ units total, you want to start looking at commercial. How they're divvied up really though depends. Um, if that helps. But I mean, we can write just a single duplex on a single uh, commercial policy, probably, but it's not going to be competitive. But again, if you have a complex and it's made up of, um, you know, 30 duplexes, that's multifamily. So
Okay.
it really depends on the composition.
Okay, great. What about investment cooperatives or condos?
Like condo associations.
Yes, like an HOA. Do
Yeah.
they have a policy, I suppose, for
Yeah, so directors and officers liability, so associations, and I do insure a lot of condo associations because the buildings itself needs to be insured, walls out coverage,
hmm,
because HO6s have walls in coverage. And that's I can do a whole other presentation on that. But for homeowners associations, generally it's just the general liability and any common areas, so pools, playgrounds, lakes, ponds, docks, yeah, exercise rooms, things like that. But HOAs or associations are automatically on commercial lines policies. There are
okay.
not that I know of any personal lines policies that would cover that.
Yeah, that makes sense.
Yeah.
They're like a small business entity, really.
Yeah. Yeah.
So Marisa asking as well, any advice for large property, 281 units, brand new, with all possible safety features and code requirements met, still seeing much higher premiums than budgeted prior to construction. Any advice there?
Great. Well, sounds like you have a good property, which should definitely make you eligible for the most competitive carriers out there and the competitive master policies too. So that's something that you can look at. Since I don't know your exact insurance situation and the carrier you're with and who you've been going to, I don't know for sure whether or not you're stuck where you are. But I mean, because premiums have gone up across the board, it's something to inherently to budget for. It's just what you're looking at. And sometimes too with the A-rated properties, the newer builds, the fully sprinklered, I am able to save money on those kinds of properties. It just depends on your current insurance situation. So
Mm,
instead of mitigating your increase, there have definitely been times where I've been able to save money uh, for the landlords in those cases. It just depends.
got it.
It really is
Okay.
all based on individual risk assessments um, and the property data.
Yeah, again,
But it's certainly possible.
wouldn't hurt to maybe talk to you and just in case there might be something better
Yeah,
there.
why not?
Okay, a few questions left from David. The Is there coverage to property if the tenant's not legal residents? They cause damages. Legal residents. Do you
Yeah,
mean
the legal
like
resident part means,
citizenship or do you mean like they're not on the lease, like legally
yeah.
tenants? I guess that would be clarification there. I know that there were a ton of comments in the chat and someone said that they weren't able to put questions in the question box for some reason. So I'm
Okay.
gonna go through the chat now and see if there's anything left there for the last few minutes here. Um, let's see. A lot of Lauren, excellent. Thank you.
Well, thank you guys. I
Mhm.
appreciate it. I hope it was helpful.
Okay, let's
And any
see.
questions that we don't get to too, I can always reach out
Yeah,
directly or we can chat after this.
I am seeing some here, but I think there are just a few in the chat. So what I'm going to do then is we do save the chat. So Lauren,
Perfect.
I'll send you the chat as well, and then also the Q&A. So if there is a question that, we didn't get to, although we got to almost everything, you can follow
Sure.
up with those people. And then also too, we did get some requests for the PowerPoint presentation. So if you
Okay.
could send that over to
Yeah.
me after this, I'll make sure to share that with everyone in the email tomorrow. So for those of you who stuck around, tomorrow I'm going to be sending you the recording, the PowerPoint slides, Lauren and the company's contact information. So if you did say yes on the poll or at the registration that you want to have a consult, we will go ahead and prioritize that. Otherwise, you can reach out to them directly as well, and they'll be. I'm sure you and your team, Lauren, are going to have your hands full. We have a lot of requests coming through for people who want
Yeah. Well, I'm
to
happy
to
to
get their
help.
policy reviewed. So thank you so much.
Sure.
Honestly, like it's just so refreshing to have a very honest view on what's going on in the insurance industry. I feel like we
Yeah.
just got to peek behind the curtain of like all of this
So
craziness that's
fun,
going
right?
on. I
Yeah.
know. I feel like I learned quite a few
Good.
things, and I see a lot of thank yous in the chats, and looking forward to hearing
Thank you
from
guys
you.
for listening to me babble about
Yeah,
insurance. I know it's not
thank.
the most fun topic,
I
but
know.
it's a necessary evil. So,
It
that's what I'm here
is.
for is to help or try and help you guys through what's going on. So,
Yeah. Thank you, Lauren. Also, I hope you
yeah.
feel better soon.
I feel fine. My throat
Thank-
just sounds awful. So, sorry, guys.
Yeah.
Next
Well,
time it'll be
thank
better.
you. Hope you all have a wonderful evening or
Thanks,
day.
guys.
We'll see you soon. Take care, everyone. Bye.
Bye.